Hey everyone, it is Evan here from the Trade Risk on Tuesday, March 17th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So the bear market of 2020 is in full force here. Volatility remains extremely elevated. Markets are digesting headlines, news, events, policies from central banks round the clock. And the Fed here in the US throwing basically everything they have at this market with a bunch of emergency sort of stimulus packages, opening up credit lines, supporting liquidity in the credit market, so on and so forth, cutting rates to zero. So trying to stabilize the markets so far hasn't really seen too much of an impact. We did stabilize today. So let's jump into the technicals dashboard here. Then we'll jump into some charts. We can see today markets did close higher by about 5%, which is, kind of the new normal in this market environment, plus or minus 5%. Basically, 3 months ago, the plus or minus 30 basis point days are essentially equivalent to the plus or minus 5% days we're seeing now. So it was a higher close towards the highs of the session. You can see the 5-day change numbers still in very rough territory, extremely red here by anywhere from 11% all the way up to 19% across the board. We are below all of the key simple moving averages here in all of the major indices. If we scroll down further and take a look here at sectors, we got the defensive tone here to the market at the top of the list. Staples, healthcare, biotech, generally not seen as a safety haven asset or sector of the market, I should say. But in this type of environment, we are getting some to the rescue here of some of the drug biotech companies that can support this crisis. Seeing a little bit of relative strength here on this week over the past 5 trading sessions. On the downside, energy, discretionary, industrials are the hardest hit, 15 to 20% lower over the past 5 days. Now, in terms of major markets, VIX still up here, 58% higher, followed by the US dollar. And the third best performer here is actually still a negative territory, and it is in the mid-range bonds, IEF 10-year bonds. Coming into third rank. On the downside, silver taking an enormous dive this week, passing USO here. Of course, USO had a very rough last week as well, but silver, oil, emerging markets in the bottom 3. So let's jump into the charts here and take a look at what's going on. So this is the S&P 500 weekly time frame here. You basically have to analyze markets on a weekly or monthly chart just to get the perspective and prior levels at this point in time. At the lows here of this week, approximately a just shy of a 30% correction off of the all-time highs made just about 4 weeks ago. So once again, pretty much breaking all historic records and the speed at which we have fallen, particularly from all-time highs into the abyss here in the S&P 500 in as straight of a line as you could imagine. Well, when we look here, a couple of things come to note when we look here at this week's candle. First thing you can see is that we are well off of the lows here of this week, which is at least a little bit promising, although it hasn't meant too much over the recent sell-off. And notice as well, we didn't quite get down to the 2018 lows. In my mind, maybe this is the retest. I know we almost retested it in the Globex session after hours or future session, but I'd like to see a regular hours, real, more concrete sort of retest here. But basically with as low as we got here this week, you could argue that we essentially have it here. And maybe, maybe that is the extent of at least this wave down for the market. Maybe it's the bottom period. But for now, we're getting a bit of a reaction here, closing back over 2,500. And now let's jump back into sort of the daily pattern here. So a couple of things to point out. First is, you've essentially been punished here if you've been trying to chase this market on these strong rallies into the close. So take, for instance, I mean, you can go back basically all of the closes where the market closed towards the highs of the session. You could go all the way back to here on March 4th, which is when things were much more mild in the sell-off here. But, you know, we had this nice rally closing at the highs. And then you saw this gap down the next day. So basically a rug pull, and we closed lower. The very next day here on Friday the 6th, again, this was a red session, so we closed below Thursday, but essentially closed near the highs of the session. If you tried buying that for optimism, you came in and got smacked here on Monday with the brutal gap down and sell-off. Very next day again, we reverse it, kind of ping pong here, close at the highs, then the rug gets pulled, close lower. This one we had a follow through day to the downside, and then if you recall last Friday we had this huge rally up to 9% close here into the weekend, and of course that was one of the biggest rug pulls yesterday, where we gapped down to those lows and then proceeded to sell off. And now today, here we are ping-ponging. So it's basically this pattern here of steep sell-off, rally into the close the next day, steep sell-off, rally into the close the next day. And essentially that has continued here in a straight line to the downside, carving out bigger down days here and causing this pullback to continue to extend itself, or this crash, I think, is probably a more appropriate word at this point than pullback. So regardless here, you know, when we look at the rally here today, there's obviously plenty of reason to be suspect of it. I do tend to think here, again, as just a discretionary look here and seeing sort of sentiment in the washout, the headlines, I wouldn't be surprised if this is the one that does finally get some upside follow through. Now, full disclosure, I'm not betting on that, inclination. This is just me, spitballing here from a very discretionary standpoint. I don't have any I'm not acting on this with any, new skin in the game. So, but I wouldn't be surprised, particularly, when we look here at the weekly chart, you can see the big tail from last week looking like buyers wanted to step in. And now with this gap down, you're seeing another tail start to form here. So I wouldn't be surprised, especially as we talked about getting so close to these 2018 lows, that we finally see at least a multi-day rally start to ensue here. Now, overstaying your welcome could be a big mistake. So, take that with, take that as a active grace here. From above, if we do get a multi-day rally, if we do get a retracement back up into, at this point, I wouldn't be surprised to see anything back up into the mid 2800s or 2800 or so, to see some type of move back up into this range. Again, that would put us at about another 10% or so higher here. I think makes sense just given the magnitude of the decline here. And again, I don't necessarily think we're out of the woods or it's an all clear by any stretch, but I think it's just really such an extreme technical washout that we've seen here, that getting a multi-day rally all the way up to into the 2800s, I think makes some sense here. Again, not putting any new positions on to play that right now, just sticking with the allocations that I currently have on. So S&P 500 down just shy of 30%, almost retesting the lows. The VIX still at 70. There's still plenty of reason to be extremely cautious and risk averse right now in this market environment. So please be careful out there. Risk management reigns supreme here. Be very cautious out there if you are trying to play any type of overnight holds. I think it's aggressive, and you definitely want to have that experience and hopefully come at it from a very disciplined standpoint if that's the game that you're looking to play. So that's the S&P 500. Really don't think there's too much other reason to talk very specifically about levels. I think the most relevant here is just, again, the 2018 lows down around 2350 or so. Maybe there's another head fake down there, but again, as I just mentioned here, I wouldn't be surprised to see a bounce finally start to take shape here. And on the upside, starting to get back above prior days highs here, breaking this downtrend line and just recovering into some of the prior week's range, I think would be just good first steps. So that is the S&P 500. If we look at the IWM here, you can see what the percentage is. I think I graphed the latest. Yeah, we sold off just 40% or so haircut here in the Russell 2000. So a pretty extreme move, again, in such a straight line. That is fascinating to see. The Russell 2000 does have a lot of energy exposure, financial exposure. So that speaks to why those are some of the hardest hit sectors in this market, speaks to why they have really gotten punished here. More so than some of the other major indices. You can see again a very similar pattern here. I mean, when we look at a monthly chart of the Russell 2000, we are far and away below the 2018 lows. We are well within the 2014 to 2016 range that the market went sideways in for multiple years. We're all the way back to those levels. So you could say, the level we traded at the lows here, right around 100 in the IWM, we were there in 2013 in this uptrend, marching our way higher. So we've absolutely retraced and reset quite a bit here for the Russell 2000 in again, a very short amount of time. If we look at the NASDAQ 100 still acting the best here on a relative basis. Notice the Russell 2000, I believe this is the NASDAQ 100, I believe this is the latest percentage here. Let's see if we can get a quick pulse. About 28.66. That's about the extent of the sell-off that we've seen here in the NASDAQ 100. Notice where we are just on a relative basis in terms of levels. We're back to essentially the sell-off point here in June of 2019. So we're nowhere near the 2018 lows. We're holding up much better. Extraordinary volume coming in. Still a straight line drop. Still the percentage move is in line with the S&P 500. But the NASDAQ 100 from a percentage basis made more progress off of the 2018 lows. So this market had sort of more to fall, so to speak, to get back to these old levels. All is to say basically that technology here, NASDAQ 100 components, tend to be faring the best on a relative basis. So back to the June lows, starting to look like it wants to hold here. We'll see if buyers can commit to this level for at least a short-term bounce. So that's it. That is, I think, what covers the markets here. It almost seems ordinary covering it in this fashion here, 5-6%, talking about double-digit percentage moves. It's fascinating how certainly acclimated we become to these new ranges here, and hopefully again everybody's thinking about risk management first and foremost, protecting yourself, preserving capital, obviously paramount to stay alive in this game, stay fighting for another chance. So that covers the market environment. Let's go to some other major markets here. Go to TLT next, which is still struggling to kind of stabilize here. Again, had this big kind of blow off epic event here back on that Monday, the 9th. It still seems to be struggling, still seems like sellers are in control here. You can see just basically every time we open up in this market, it tends to be sold off and we close near the lows. The exception to that was yesterday on Monday, but you can see we just totally gave this all back and again closed at the lows here. So TLT weekly time frame, again, longer term trends all still very much pointing up, but in the short term, the exhaustion here kind of coming back down to earth. You can see slicing through some of this nearer term trend lines that were in place and starting to break down, looking like it wants to do sort of a second leg lower back down into the 140s. We'll see if that actually happens here, but TLT still seems to be under pressure, but of course holding, faring a little bit better than equities generally speaking. Now, if we go to gold next, gold, we talked about in our last video here about how bearish this last week was, the 9% down, bearish engulfing, basically all of this prior year. Our call was that we would expect more follow through back down to retest the 130s here, the mid 130s, which was essentially the fourth quarter lows here. And lo and behold, we've got that retest in just a couple of days time, because we came and opened up on the week down here around 136, right into that support, and buyers did step in, and we are trying to rally right now. We're back to slightly green territory here in GLD. So it is a nice save. That is exactly where you'd want to see buyers show up. So we'll see if they can continue to hold that level. It's going to be an important level for gold bulls to hold on to. So going forward, we'll see if we can close the week up here into the green or above 137. And going forward, that I think is a good line in the sand to use. Now, silver, on the other hand, is not faring as well. In fact, quite the opposite. It is in a meltdown mode here, as it's down 13% this week. Of course, it's only Tuesday, so basically all of that sell-off came from yesterday with the brutal gap down here in silver, totally breaking down from all of the prior lows from the past several years. If you recall, from 2015 all the way to 2019 in silver, we found support, and we found basically the lows coming in right around 13 and change, 13 and a dime, 13 and a quarter here for the SLV ETF, and we have totally broken below that in a quite a meaningful way. So silver here looks broken in the short term, momentum all very much to the downside. It's certainly extremely oversold on all traditional metrics, but of course, as we've learned looking at the market recently, oversold does not give you a reason by itself to just jump in and buy blindly. So you have to be careful here, but just seeing a historic kind of meltdown here in silver, just in the magnitude of its move. This thing was trading up near $18. It's now down around 11 or 12. Basically had a 35% sell-off in 3 trading weeks. So pretty large move here for SLV. Last but not least, if we look at energy, USO continues now to make new lows. It is breaking below the prior week's lows, and again, you can see this meltdown is still very much in motion here, still putting tons of pressure on the market, just generally energy sector still getting weighed on. Of course, if we do start restricting travel, if we start doing any type of nationwide lockdown in the US, of course, that is going to continue to dry up oil consumption here, just in terms of transportation. So obviously, feeling the effects on multiple levels here is the commodity of crude oil, and the pressure here just remains on this market. Last but not least is natural gas, starting to move back down here, but still holding up quite well, just all things considered. Given what's going on in some of the other commodities here, we're going pretty quiet, moving sideways here. Again, hasn't quite lifted off, hasn't quite broken above that 50, multi-week range here of around 15 and a quarter. I still think that's the important range to pay attention to, but for now, it's still kind of just moving sideways here. Get some positive MACD divergence. We'll see if that starts to mean something. For now, though, it is back to range-bound behavior in the context of a longer-term downtrend for natural gas. So that's it. That is what I got for the midweek video. Again, lots going on there. We've seemed to have hit limits up and limits down here on the overnight session. So futures have been pretty quiet, just because they tend to circuit breaker out, and then we have to wait till the market open. Nonetheless, though, very eventful, very dangerous market, and it's moving pretty fast. So again, protect yourself among all else. As always, thank you for tuning in and watching. Hopefully these videos are helpful for everyone to sort of navigate what's going on here. Again, take a deep breath. Don't have to trade every day. I think that's something we should all be thinking about as markets really pick up their speed. We should probably be doing less and going in the opposite direction as traders. And of course, if you're a day trader, then these types of environments are uniquely beneficial for you if you are experienced enough to sort of capitalize on that intraday movement. So that's it. Thanks again, as always, for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great rest of your week. We'll see you back here tomorrow for some trade ideas. We'll see if there's anything that's still standing, showing some relative strength, and hopefully we can highlight some of those stocks to keep an eye on.